India's election throws a curveball into the markets, with Narendra Modi's BJP failing to secure a majority. US markets increase their Fed rate cut bets after soft job openings data, and in Australia, weaker net export figures could be a drag on GDP data out today. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Economist Dhiraj Nim explains what India's election result could mean for fiscal and monetary policy there after Narendra Modi's BJP lost its majority while still winning the election.
I think the Reserve Bank of India will remain eminently focused on bringing inflation down and at the same time supporting the rupee's stability as they did today.
But first in 5 and 5 with ANZ, US Treasury yields were down 6 to 8 basis points this morning, and the S&P 500 was off about 0.2% by 4 a.m. Sydney-Melbourne time, as weakness in the US labour market led traders to reassess when the Federal Reserve can start cutting interest rates. US job openings declined in April to their lowest level since 2021. Suggesting labour demand continues to weaken ahead of the important non-farm payrolls data at the end of the week. Markets now see the chance of a September cut by the Fed at 75%, up from 60% at the end of last week. The Aussie dollar was down 0.6% at 66.49 US cents, while the Kiwi was down 0.1% at 61.79 US cents. The key in Australia today is GDP data for the March quarter, after a weaker set of final partial data yesterday. ANZ senior economist Blair Chapman says weaker net export figures have led ANZ to reduce its quarterly forecast.
We've revised our call down from 0.3% quarter-on-quarter to 0% quarter-on-quarter. Basically, today's numbers came in and we're a bit weaker than we were thinking, with net exports likely to really drag on the economy and public sector not contributing as much as we thought as well.
Number 2, the Bank of Canada will be the first major central bank making a rates decision this month. When it meets tonight, ANZ FX analyst Felix Ryan says markets are pricing in over a 90% chance of a rate cut. The Bank of Canada's key policy rate sits at 5% at the moment.
Headline inflation has fallen from a peak of 8.1% year over year in June 2022 down to 2.7% as of April this year. Progress has also been made on trimmed mean and core median inflation, which as of April are just back in the Bank of Canada's 1 to 3% target band for inflation. Retail sales in March was down 0.2%, though preliminary April data showed a 0.7% rebound. Q1 GDP released last Friday missed expectations of 2.2% annualised, coming in instead at 1.7%.
Number 3, South Korea's CPI inflation fell to a 10-month low in May. That's 2.7% from a year ago, a touch below expectations. ANZ Head of Asia Research, Koon Go, says the decline looks set to continue.
The decline is largely due to base effects. The high-frequency data suggests that some of the increases in retail fuel prices have eased and food prices have also declined. So that's helping to push the headline inflation lower. We expect headline inflation to converge towards the 2% target set by the Bank of Korea within the year, and that should pave the way for the Bank of Korea to deliver first rate cut by Q4 this year.
Number 4, the Philippines and Thailand release May CPI data later today. Koon says inflation looks set to pick up in both economies, including a jump to 4% annually in the Philippines.
Now that's at the top of the BSP's official target range, and we find it difficult for the BSP to cut rates, which is what the governor had indicated they might do as soon as August. We think there's still quite a bit of underlying inflation pressure, especially with the recent weakness in the Philippine peso. So we think inflation could stay elevated, and that would really hinder the ability of BSP to cut rates early.
Number 5, in Thailand, Koon says annual inflation should rise into the central bank's target range at 1.3% annually. It had been below the 1 to 3% range due to a weak economy.
The rise in inflation is due to largely base effects, but also signs that there are some improvement in economic activity. Now, we expect the BOT to be in a position to cut rates, possibly in Q3. In the meantime, the passage of the recent budget should help to spur some activity and lead to an ongoing recovery in the economy, which should help to see inflation head further higher in the coming months.
Couldn't go there. Now, in our bonus deep dive interview, ANZ Economist Dhiraj Nim spoke from Mumbai this morning with my colleague Alex Tarrant about the surprising results of India's general election, which show Prime Minister Narendra Modi's BJP losing its parliamentary majority.
I think it's very far from what the exit polls had predicted, which was a sweeping victory for the NDA coalition led by Prime Minister Narendra Modi. They had also predicted that the BJP would be able to secure a simple majority to form the government by itself, like in 2014 and 2019. Now, both of these assertions of the exit polls have not materialized in the actual election results. The NDA coalition has secured about 290 seats. The results are still pouring in, but it won't change a lot. And the BJP by itself has not secured a simple majority. Now, this is, of course, where, market expectations were not vindicated today.
And what have we seen in the markets? The stock market was trading up the day before, but what are we seeing now?
Well, understandably, markets reacted very negatively as the counting progressed and results were being firmed up. Equities were down about 5% or more for the day, which was really a very, very sharp fall. Bond yields surged past 7%, and also the rupee was experiencing a lot of pressure, which we think was contained by the Reserve Bank of India's intervention. But they did keep it close to its record lows of about 83.50 to 83.50. So overall, a very negative market reaction, especially relative to what had built up on the day when exit polls were released.
What does this mean, do you think, for economic policy in India and for the RBI?
Look, we're viewing it in two parts. The first is what has not changed. So we have not altered our economic projections for India for FY25. That is the fiscal year ending March 2025. We still expect GDP growth at 6.8%, which is close to potential, and CPI inflation to average about 4.3%. In terms of the fiscal policy, one may argue that since today's victory was not as large as many were expecting, the government may be forced to abandon fiscal discipline to some extent, or they may want to spruce up revenue spending at the cost of, let's say, capex and things like that. We think it will not happen in FY25. Remember, the Reserve Bank of India has made a very large transfer of dividend to the government to the tune of 0.6% of GDP, much higher than the budgeted. So I think in FY25, the central government will have a sufficient elbow room to spruce up revenue spending while adhering to the fiscal deficit target without cutting capex. So it will not be a tightrope act, so to speak, on the fiscal front in FY25. For the monetary policy as well, the calculus has not changed. I think the Reserve Bank of India will remain eminently focused on bringing inflation down and at the same time supporting the rupee's stability as they did today. So overall, for FY25, I don't think there's a lot of economic risk coming on the back of this development. But we do think some challenges lie in the medium term. And that is exactly why we can be a bit concerned, or markets may have reacted this negatively. The reason is that the BJP no longer will have an unassisted majority in the lower house, which means that to push through with key reforms, they will face a lot more difficulties, or they possibly will face a lot more friction, let's say, from within the coalition government of the NDA and a larger opposition than before. So it will be very difficult for them to pursue some contentious reforms, such as in the areas of land, labor, agricultural markets, so on and so forth. And these reforms are very critical to unlocking higher potential growth for India. On the fiscal front also, the government may find it difficult, or its resolve to consolidate fiscal accounts may get tested in FY26 and beyond. They may find there is a need to spruce up welfare spending, social sector spending, which may come at the cost of capex in the later years. And capex has been at the heart of India's growth story so far. So that could be a slight challenge and a tightrope act. Look, in all, today's elections were despite India's very solid GDP growth, which means that voters are possibly more concerned about some deeper economic issues such as high inflation, unemployment, especially among youth, a weak rural economy, and perhaps even widened economic inequalities. And I think no government can or will want to avoid these challenges in the medium term.
Dhiraj Nim there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, June the 5th. Catch you tomorrow with reaction to Australia's GDP data and what it might mean for the RBA. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.